Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Welcome to today's show. Today's guest is Brandon Hall. He is the CEO of the Real Estate CPA. His team is dedicated to helping high net worth individuals and real estate investors with reducing their tax bills and streamlining their accounting functions. Brandon, welcome to the show.
Thanks, Ryan, for having me on. I really appreciate it.
Awesome. Well, let's jump right into it. Walk us a little bit through your background.
Yeah, so I graduated from college in 2013 and started working at PricewaterhouseCoopers, Big Four accounting firm. Realized relatively early on, I think I was about 3 months in, I was like, it's just not for me. I've got to go and build wealth, and I didn't feel like a W-2 job at the Big Four was going to make a lot of sense. So I started looking around, found real estate, started investing in real estate, and then just also happened to start answering a lot of tax and accounting questions for other real estate investors. And this CPA firm kind of emerged from that. So we're about 5 years into the CPA firm at this point, and we've got 15 employees and about 500 plus clients across the United States.
Oh, that's awesome. Congratulations.
Thank you.
That's awesome. So walk us through the tax benefits of multifamily and how these benefits differ for sponsors versus passive investors.
Yeah, well, there's a lot of tax benefits. There's tax benefits just through investing in real estate in general. Which is why you see all these types of opportunities out there where you have a couple of people that sponsor a deal and they go in and they raise a couple $1 million. So if somebody's giving them the millions of dollars, it's typically people that have high income jobs or want to be very passive but want the real estate exposure. And again, a lot of that real estate exposure, aside from it just being a great investment class in general, it also comes with a lot of good tax benefits. So when you invest in multifamily assets, especially if you start to get into the larger multifamily assets, there's a lot of ways that we can work to reduce the tax impact across the board. So the first thing is, do our limited partners, are they paying tax on any sort of distributions or cash that they're receiving throughout the hold period? Ideally, they're not. And there's a couple ways that we can do that. We can run a cost segregation study on the multifamily property, which a cost segregation study is the practice of allocating value out of the 27.5-year depreciation bucket. So whenever I go and buy real estate, investment real estate, I depreciate the cost over 27.5 years, meaning I basically take that purchase price, I subtract the land from it, the land value from it, and then I divide that, whatever that net amount is, by 27.5 years. That's depreciation. I get to claim that number every year, even though I don't actually spend that amount every single year. So it's a deduction, it's a free deduction that I get to take that is supposed to track the deterioration of the asset over time. So when you do a cost segregation study, you take value out of that 27.5-year bucket, that 27.5-year life, and you allocate it to 5, 7, and 15-year life. So what we're trying to do is we're trying to say, well, if I go and buy a 200-unit apartment complex, there's carpet in that apartment complex, there's appliances, there's cabinetry, there's all these things that are not going to last 27.5 years. So a cost segregation study is the practice of assigning value to all of those things, and then assigning a life of 5, 7, or 15 years. Well, if I can do that, then I can take a 100% bonus depreciation on any component with a useful life of less than 20 years. So in a standard multifamily acquisition, I can generally allocate 25 to 30% of the purchase price to 5, 7, and 15-year properties. So if I buy a $10 million property, I can probably get a $2.5 to $3 million first-year bonus depreciation deduction, thanks to 100% bonus depreciation. So once I take that, that's a huge loss. It's a passive loss that I get to then spread out amongst all my investors and potentially even claim myself. So in terms of the upfront benefits, we typically always see a cost segregation study run. People will book really large losses in the year of acquisition, and that ultimately provides them with some really big tax savings or tax refunds in some cases. So that's I would say a really important benefit. But the alternative benefits, which I know that we're going to get into here in a minute, are with the 2013 tangible property regulations. If I buy, the larger the property that I buy, the more that I get to write off as I'm doing rehabs throughout the hold period.
If someone invested, let's say $100,000 into a multifamily asset as an LP, what percentage are they typically looking at in terms of a year one bonus depreciation?
Yeah, it's a good question. It definitely depends on the type of asset that you're buying. If you're buying multifamily asset, and if I'm an LP, a limited partner investor, and I put 100K into a multifamily asset, I can generally expect anywhere between a $92,000 to $100,000 loss being passed back to me.
Okay, awesome. And then just touching upon how the tax benefits of multifamily compare versus traditional asset classes like stocks.
Yeah, well, I mean, stocks are, so I think it's important to have a diversified portfolio to some degree. I'm overweight real estate, which I'm not a wealth advisor, so that could be the wrong advice. But in terms of stocks, the problem is just, the problem with stocks is there's no current cash flow unless you have dividends, and there's no way to shelter that current cash flow. Additionally, whenever you liquidate, I mean, that's kind of when you really cash out is the liquidation, unless you're running some sort of tax loss harvesting strategy. The problem with stocks is that there's just not any tax sheltering. And the other problem that most of our clients don't really like about the equities market is that you're giving your money to somebody you don't have any control, or you're giving your money to a corporation you don't have any control, which I know that we just talked about syndicates, and you're definitely giving your money to a sponsor and you don't get any control. But that is, I think, why a lot of people look to real estate, at least initially, is I want to be able to buy a 4-unit apartment complex, four-unit property, and have control, call the shots. If I succeed, it's because I succeeded. If I fail, it's because I failed.
Sure.
So yeah, control, I think, is a big difference. But with real estate, I mean, you can invest, I'm not gonna throw out a number, but you can invest in real estate and you can receive cash flow and not pay tax on the cash flow, which is what we help our clients do.
Oh, nice. And then if we looked at passive investors versus sponsors in terms of the bonus depreciation, how does that work, and kind of what's that allocation?
Yeah, so the tax code says that you are not allowed to receive a distribution in excess of your basis in the partnership. So if I invest $100,000 in the partnership, my basis in the partnership is $100,000. If you then go and turn around and give me $101,000 as a cash distribution, then I have to pay tax on $1,000, that $1,000 increase, right? So what happens when you run cost seg studies is you actually reduce everybody's basis in the partnership. So if I invest 100K and then I get a $92,000 first year bonus depreciation, now my basis in the partnership is $8,000. So that's what you're doing there. So what'll happen is if I invest 100K, we run bonus depreciation. You would allocate 100K of losses to me. So I would get my 100K, my full 100K would come out as a loss that I'd be able to claim hopefully on my taxes. And then any excess loss would then be allocated to the at-risk partners. And when we're running LLCs, we have to really try to figure out who is actually at risk. And that typically takes looking at the lending agreement to figure out who the lender can actually go after if the LLC defaulted on the loan. Because all these loans are non-recourse, right? Which means that at the partnership level, they're not going to go after the LLC. They're just going to take back the property. But typically, there's some amount of recourse in there somewhere. And so that's what we have to figure out, is what partners ultimately are going to be responsible for paying that loan back. And the excess loss in that case gets allocated to them. So if you buy a $10 million apartment complex, you raise $2 million from limited partners. You've got a limited partner capital account of $2 million. Run a cost seg study, that's a $3 million loss. You allocate $2 million of the $3 million to your limited partners, you wipe them out, and then you get the $1 million remaining if you're guaranteeing the loan in any sort of fashion.
Okay, got it. No, that's really helpful. And then in terms of the implications on tax returns, if you are passive versus active, how does that look like at tax time? You had talked about wiping them out. What else should they think about or be aware of?
Yeah, so passive losses can only offset passive income or gain on sale of rental property. So if I invest as a limited partner in these deals and I get $100,000 passive loss, that loss is a passive loss. I have to have positive passive income from some other source. Otherwise, that loss is suspended and it's carried forward indefinitely until I can utilize it or until the activity that generated the loss is sold. So what a lot of people go after is they go after the real estate professional status. It's defined in section 469 of the tax code. And that status says it's an exception to the passive loss limitation. So it basically says if you are a real estate professional and if you materially participate in the rental activities or in the rental real estate or the real property trader business, then you have non-passive losses from your rental activities. And non-passive losses can be used to offset any other type of income. So like W-2 income, stock income, anything like that. So a lot of people are after that status. To be a real estate professional, you have to spend 750 hours in a real property trader business and more than half your time in a real property trader business. Owning rental real estate is a real property trader business. That's step one. The second step is to materially participate in the real property trader business. Typically, it's 500 hours or more spent in that activity. So most of the limited partners will not qualify. Well, there's a couple reasons for it, but in general, limited partners are not going to qualify on that activity because they're not going to be materially participating in that activity. They would have to have their own rental portfolio out on the side.
Okay. And then what, maybe provide some examples of what allows you to materially participate. What are some examples of you getting that check?
Yeah, it's a great question. So I like to say that it's hours that are spent making the property operate, basically. So making the property go. You have to be moving the property forward. Reviewing my property manager's monthly statements, that's an investor level activity. Reviewing the deal's quarterly financial statements is an investor level activity. I'm not going to be able to book that time as real estate professional or material participation hours. So collecting rents, managing rehab budgets and schedules and projects, managing all the contractors, doing the repairs yourself, the maintenance yourself, the landscaping yourself, focused on acquisitions. Maybe you are a GP and you're a sponsor in several deals and you guys are acquiring multiple deals a year, and all your role is acquisitions. Well, that could count too. Where a lot of people get tripped up is they think that research time counts and education time counts, and it does not. It could in very limited circumstances, but in general, we tell our clients don't count on it. Record it, we'll look at it, but don't count on that time counting. You really need to be operating the property in order to have hours that you're going to be able to substantiate. And sometimes people get upset when you tell them that too. They're like, well, I just spent all this time researching. Well, sorry, but if you're audited, that time's going to get thrown out, and we work to protect you under audit.
Okay. No, that's and so even if you have a third party property management and you're working with them, on weekly calls twice a week, that counts as, and you're running the business plan.
Yeah. I would say that counts. If it ever turns into they're just reporting to you once a month with their financials and you're just reviewing them with a couple comments back, then that's not really running the property anymore. So.
Sure. Okay. And then, what about serving as a key principal, a KP? Does that qualify you as an active investor?
Well, so you can call yourself whatever you want, but the only thing that matters is the number of hours you spend and where you spend them. So that's what we're looking for real estate professional status and material participation. Okay. If you materially participated in the activity, and if you spent 750 hours and greater than half your time in a real property trader business, then you'll qualify, regardless of title or position.
Awesome. And then, so we walk through real estate professional, bonus depreciation. Walk us through, if let's say this one of the spouses is working and the other one becomes a real estate professional, walk us through the benefits there and how that can happen.
Yeah, well, so the benefits are that one spouse could have a W-2, oftentimes a high W-2, so they're earning a lot of money. The other spouse is focused on building the real estate portfolio, sustaining their wealth, so to speak. And the spouse that's working on building the real estate portfolio, they can qualify as a real estate professional on their activities on the real estate portfolio. So oftentimes that's exactly what we'll see happen. We'll see one spouse that will take the reins on the real estate portfolio. The other spouse will be working a W-2 job. And because the one spouse is a real estate professional and materially participates in the rental real estate activities, the portfolio, then the losses coming from that portfolio are non-passive and they can be used to offset the other spouse's W-2 income. Starting in 2021, that is most likely, I say most likely, I mean, starting in 2021, we have excess business losses. So if you have one spouse that's a W-2 job, the other spouse is working on the real estate rentals, and there's no other business income, no other business activity, then the loss will be capped at $500K a year. The non-passive loss will be capped at $500K a year. The excess will be considered a net operating loss. That starts in 2021.
Okay. So it kind of reduces some of the benefits potentially of multifamily investment.
Yeah, especially if you're syndicating. So we've had a lot of clients that would, you would have one spouse that's the lead sponsor, the GP, and they're reaping all of these losses and offsetting the other spouse's high W-2 income. That's now going to be capped at $500K.
That will be capped or won't be capped? Sorry.
The loss will now be capped at $500K unless you have other business income. So it's all about the excess losses over your business income. So if I have no business income other than my real estate, my rental real estate, then the losses are going to be capped at $500,000 a year going forward.
Do you see any risk of real estate professional status being phased out?
No. I mean, it's been around for a long time. It's a legitimate piece of the tax code. And no, I don't see why they would phase it out. It's not abusive. And the reason that it's not abusive is these losses are primarily generated through cost segregation studies, and the cost segregation creates depreciation. That depreciation has to be recaptured at some later point. So it's kind of just like a loan from the IRS for the time being, but I don't see anything that would point to it potentially being phased out.
And then for bonus depreciation, my understanding is that there's some rules that phases out, in a certain period of time. Maybe walk the listeners through what that's like and why.
So bonus depreciation, so now it's 100%, and it was 100% thanks to the 2017 Tax Cuts and Jobs Act. And it is going to be phasing out. It starts in 2023. So in 2023, it's going to drop to 80% bonus depreciation, 2024, 60%, 2025, 40%, 2026, 20, 2027, none. So basically drops by 20% every single year until it's totally phased out. My expectation is that, I don't know what's going to happen, but my expectation is that there's going to be some pretty serious lobbying starting probably 2022 to extend the bonus depreciation rules to get rid of the phase out. That you typically see that happen when things get phased out of the tax code that provide some sort of benefit. So I would expect to kind of see some sort of lobbying.
And who's the lobbyists that do that? I mean, what groups voice that?
Oh, well, you've got cost seg firms that are all around the country, and they've got big coalitions, and they'll go in on it all with each other. You've got, I don't think 1031 exchange companies would have anything to do with that, but yeah, I would probably expect to see it from the cost seg firms, and they'll rally a bunch of people, such as other investors that they work with and might have any sort of political pull. So I would definitely say cost seg firms, real estate investors, anybody that benefits from the cost seg studies, I would expect to see them.
And that'll be a loud enough voice, you think, to enact change?
Well, I have no idea. Yeah, we're just going to have to kind of wait and see.
Yeah. And then walk us through some, details with tax distributions, or cash distributions, I should say, in syndications and how those are taxed.
Yeah, so cash distributions are not taxed as long as you have basis to receive the distributions. So kind of going back to that 8K example, if my basis is 8K and I receive an 8K distribution, I'm good. I don't have to pay any sort of tax on it. If I receive a higher distribution, I might not be good. So it's really just based on the basis in the partnership. That kind of depends on how that cash distribution is taxed. Most of the time, we don't see any issues.
People talk about a return of capital versus a return on capital. So what's the difference between those, and why does it matter?
From a tax perspective, it doesn't. It's actually funny. We work with a lot of syndicates who like to say that in the operating agreement, the cash distributions can be treated as a return on capital or of capital, sorry. And we go, well, it doesn't matter. What matters at the end of the day is what is the basis that this investor has and how much money they're receiving.
Okay. And so when we talk about basis, so if you put in 100,000, you had a cost seg study done and you got 80,000 of year one loss, and then your cash distributions were 20,000, then those wouldn't be taxed, correct? Because
correct,
your basis. But let's say the cash distribution the following year was 10,000. So how does that then tax, that 10,000? Because it's exceeded your cost basis, I guess, right?
Yeah, so the question would be the following year, what is the profitability or what does the net operating income look like from the entity? So my basis is affected by any sort of capital contributions, any sort of loans that I'm guaranteeing. That all increases it, right? The profits of my allocable profits of the partnership, that increases my basis. Losses decrease my basis, distributions decrease my basis. So at the end of the day, it just depends on every single year, what does the operating income look like?
So that's at an LLC or asset level, how that looks, and then distributed accordingly in terms of that basis after the initial investment. Mm-hmm. Okay. And then upon exit, how are capital gains treated? So let's say you hold a property, let's look at an example. If you just held it for 2 years versus 5 years, is there any difference in how that sale is treated?
So no difference if you hold it 2 versus 5. If you liquidate the property before 12 months elapse, that's where you're going to get the difference. But we don't really see that in the syndicated space unless they're syndicating developments or something like that. So in syndicated multifamily, typically the way that it's going to work is they're going to hold for 5 to 7 years. They're going to liquidate on the back end. Now, when you liquidate, you're passing 2 types of gain to your investors. You're passing capital gain, and you're also passing depreciation recapture, which is called unrecaptured section 1250 gain. So depreciation recapture is the one that always catches people. And the way to illustrate it is if I bought a property for $100,000 and I later sold that property for $105,000, you may think that that's a $5,000 gain. But when I sell the property, we have to look at what my remaining basis is, my adjusted basis in the property. So if I buy my $100,000 property and then I depreciate it $20K over the hold period, my basis is $80,000, my adjusted basis. So then if I go and sell it for $105, I now have a $25,000 gain. And sometimes people go, well, that doesn't make sense. Why is that fair? Well, it's fair because you got the depreciation up front. Or over time, but in the case of multifamily, you ran the cost seg study. You got the big deductions up front. So the time value of money pays off for you, but now you got to pay it all back. So whenever you sell multifamily, there's 2 types of gain. You've got that depreciation recapture. How much depreciation have you taken? You're typically going to pay about a 25% tax on that. I say about because you could pay lower, and you could potentially pay higher depending on how everything works out. But then on the other side of the coin, you've got that 15% long-term capital gain. And then you always have to watch out for the net investment income tax on top of that, which is a 3.8% surtax if you're earning above 250K. So the liquidations can be pretty expensive. And then our role in that is just making sure that we're coaching our deal sponsors on how to talk to their clients about it. Because you don't want to get into a situation where a limited partner has been spending everything they've been receiving and they've got no capital reserved. And at the end, it kind of depends deal to deal how much capital there is to actually pay out. An investor might have already received their pref or their IRR, and the payout is just almost their original contribution. And if that's not enough to cover the taxes, they could be left in a situation where it's not a very good one financially.
Okay, and then you had talked about it could be 25 plus or minus. So what drives that differential? In terms of
so when you run cost seg studies, if you sell the property, you're going to have ordinary income generated from the recapture of like the 5, 7, 15-year property. Mm-hmm. So you could be at a higher rate. Now, typically on the back end, you're going to be doing some sort of allocation to reduce that, right? To say, well, the carpet that was $5,000 when I bought it year 1. Now its market value is $500. So there's typically a big reduction in place whenever we liquidate.
Okay. And so you look at on the back end, that recapture might not be as much. Is that what you're saying? Okay,
Yeah.
interesting. Okay, and then in terms of, let's say you started, year one, you're a syndicator, bought an asset, and you are in the highest tax bracket, and then 5 years later you go and sell it, and you are in a lower tax bracket. The recapture would be taxed at your initial tax bracket or your current tax bracket?
Current tax bracket.
Okay. So there's a tax arbitrage there if that works for you. Yeah. Okay.
Definitely.
Awesome.
And you could take the capital distribution from this one syndicate, right? Let's say that I've got a 100K capital gain and I get an $80,000 distribution. I can go take that $80,000 and roll it into the next syndicate. I shouldn't say roll it into, that gives the false impression that you can like do a 1031 exchange or something.
Sure.
But I can take that 80K and go and put it into a new syndicate and get a $75,000 loss that then offsets the 100K gain. So
sure.
There's still ways, even as a limited partner, to reduce your overall tax burden in the years of liquidation.
Sure. And then for a limited partner, if they have recapture like that, and they, as you mentioned, they go and find another limited partner deals, they can use that bonus depreciation to offset the recapture obligation? Okay.
Absolutely.
Okay. And then is there anything that people can do to mitigate the taxable gains upon a property sale? You had, mentioned 1031. Maybe just walk us through some things that, strategies in 5 years, what people should be either planning for, maybe in years 3 or 4, or how to get ahead of that.
Yeah, well, there's a lot of things that you can do, and the question is just what's ultimately going to be best for you. The more creative you get, typically the more expensive it's going to get as well. So you got to kind of factor that in. But if you can do a 1031 exchange, then that's the easiest solution. But it's typically not very easy in a syndication because you've got to get all these partners on board with this 1031 exchange. So the partnership itself has to do the 1031 exchange. You can't drop out of the partnership and then exchange your interest in the partnership. It doesn't work like that. So because of that, even though a 1031 is probably the easiest thing to do, we typically don't see 1031 exchanges unless they're really small partnerships, like 5 or 10 people that they can go to and really convince everybody that this is the right move. So on the flip side, probably the most straightforward thing to do is to, in effect, do your own 1031 exchange. And not technically a 1031 exchange, but kind of what I was just talking about. You get your cash distribution, you put it into the next property, you cost seg that property, you take the loss, you offset the gain. All has to happen in the same calendar year, but you can effectively do all this on December 31st of that same calendar year if you wanted to. So that's typically a good option to explore if the syndicate liquidates in Q1 of any year, because it gives you plenty of time to figure out what that replacement asset is going to look like, or what that replacement investment's going to look like.
Sure.
If you have really large gains, probably 300-400K plus, you could look at deferred sales trusts. It's basically the deferred sales trust would take the position and then pay you out on an ongoing basis. They would give you a down payment for your position and then pay you out with installments on an ongoing basis. And those are nice because they're really flexible. You can restructure them at any point. And it effectively gets you the deferral. It's not elimination, but it gets you the deferral over time. So that's typically good for people that have really low basis, a large gain that they're looking at, but they are expensive to run. I mean, they're very expensive to run. So that's why I said 300, 400K gain. Yeah, I mean, those are kind of the key things to look at there. There's some other techniques that you can use, and you can get kind of crazy with the 1031s, but those are kind of the basics.
Yeah, that's great. No, I appreciate that, Brendan. Thank you. And then just some quick tax questions as these things come up. They're kind of hot button issues. So in terms of creating a special class for our IRA investors that where they're not allocated depreciation, what are your thoughts on that?
As long as the transaction has economic substance, then you can do whatever you'd like. So if you want to allocate depreciation to the IRA owners, that's fine. It will help them at some point because they can book the losses. And then whenever you've got that gain, you're allocating it to them, they can offset it. But they don't necessarily need to. And why would they do that? Well, if you've got debt exposure, you have UDFI, unrelated debt financed income, and then they've got UBIT, right? So they have an interest in booking the losses, even though at face value, it might seem like they don't.
Okay. Okay. And then in terms of allocating depreciation to investors, should it be, how do you advise people? Is it more at capital at risk? So if a syndicator has money in the transaction, it should be allocated on how much capital has been invested in the deal, or is it just more on cash flow distribution splits?
Yeah, so you can do this in a number of different ways, and I don't think there's one way to do it.
Okay.
I think there's a lot of different ways that you can do it. It just kind of depends on what everybody's trying to achieve in the deal, and I think that makes it attractive because investors can invest in the deals that they want to invest in and get the results that they're looking for as a result.
Sure.
But you can certainly allocate all the depreciation to one class of members and none to the other class of members. Most common what we see is all the depreciation, all the losses are allocated to the class A members, which are typically the limited partners. And once their capital accounts are all brought down to zero, the remaining is then allocated to the at-risk members.
Okay.
And the at-risk member are typically a couple members of the GP.
Okay. Got it. And then in terms of the CARES Act, what are some of the potential tax benefits for either listeners of the show or people involved in multifamily syndications?
Yeah, so people involved in multifamily syndications, if you're a limited partner, probably not a whole lot there for you. If you are a sponsor, that's kind of a different story. If you can achieve real estate professional status, you should definitely freshen up on the CARES Act and what's in it for you. So the big one is the net operating loss provisions. Those have been basically suspended until 2021. Meaning that you can go and create a net operating loss today and you can carry it back 5 years. And how do you create a net operating loss? Well, you have to create a non-passive loss. How do you create it? You have to create a non-passive loss that's in excess of all of your income. Okay. So how do you create a non-passive loss? Well, you qualify as a real estate professional in a real property trader business on the rental real estate activities. You materially participate in the rental real estate activity. So if we kind of go down that chain, we can see if I'm a real estate professional and if I acquire a bunch of property in 2020, and I cost segregate everything, or even if I acquired in 2019, 2018, 2017, and I decide that 2020 is the year I'm going to actually cost seg all that stuff and accelerate all my missed depreciation that I could have taken if I had cost segged it all in the years of acquisition. 2020 is your year. If you're a real estate professional, you want to cost seg everything, create large losses, ideally creates a loss in excess of your income, and now you have an NOL that you can carry back 5 years. This is only going to work through 2020. So starting 2021, we have that $500,000 cap that I was talking about.
Okay.
And that's going to kick back in. So it's a time sensitive, but you might already be in a situation where all you have to do is just cost seg the properties that you previously purchased in prior years.
Okay. And what if you were not a real estate professional, let's say in 2019, but you are in 2020? Could you
it's all
still
about the year that you book the loss. So yeah, so if I was not a real estate professional in 2019, I can be a real estate professional in 2020, cost segregate my 2019 property, file a 3115 41A adjustment, which just is technical speak for accelerating the loss, and take it all in 2020.
Okay, awesome. And so there's no cap, like you said, on how much losses you can take back.
Nope.
But everything would be, recaptured at some point, but it could be at a lower tax basis.
Yeah,
lower
exactly.
Tax rate. Okay, nice. So let's just see. And then in terms of, people listening may be like, hey, this sounds too good to be true. I can offset, historical W-2 income and so forth. How do people just make sure that, I guess, what do you do for your clients to make sure that people don't get audited or to reduce the risk of audit?
Well, so we don't really focus. I mean, there are certainly some things that you can do to reduce audit risk or the risk of being audited, but I try to be very careful when we talk about audits because we're not really under the belief that you should reduce your risk of being audited. We do believe that you should be able to substantiate everything in an audit, and that's what we work towards with our clients. It's interesting because, as an example, we'll take real estate professional all day long. It's relatively black and white. There's tons of court cases on it. There's tons of great material on it. If you just invest the time in understanding it, which is a lot of time, don't get me wrong, But if you invest the time to really read it, comprehend it, and understand it, what you'll come to realize is it's not really a high risk strategy at all. Yeah, it creates a big refund, and at face value, that might seem super risky. But then you take that to CPAs that don't understand real estate professional status, and they will tell you this is extremely risky. Well, it's not. It's just that I've invested in the education. So that's why we try to say, look, we're not going to, we don't want to necessarily focus on audit reduction. We want to focus on audit substantiation. We want to substantiate everything so that we win audits should they come up. But there are things that you can do. I mean, if you have a really big Schedule C, right? Like you have a Schedule C that's showing really large net income, you can definitely move that into an S corporation or into a partnership, because those historically have been audited less. Doesn't necessarily mean, I mean, you can move it in there and get audited the very next year, so you could just be not a lucky person. Okay. But you know that. So like I said, there are some things that you can do, but we don't really focus on that. We focus on the substantiation.
Great. And then in terms of at the property level for owners, operators, how can they operate their property more tax efficiently? Whether that's through, you know, capitalizing rehabs versus expensing them, and just walk us through, you know, some tips or so forth that you could provide.
So if the operator has a CPA that understands how to apply the 2013 tangible property regulations, then all the operator has to do is keep invoices in a very meticulous fashion. And that's it. The CPA at the end of the year will take care of the rest. But to kind of elaborate on that, the 2013 tangible property regulations, they basically tell you how, if you step through those regulations, they basically tell you how to treat expenditures. Do you capitalize the expenditure or do you deduct it as a repair? There are examples in the Internal Revenue Code. There's an example specifically, I think it's example 10. I forget which section it is, but there's an example in the Internal Revenue Code that basically says, hey, if you have a 10-unit property and you replace one HVAC unit, then that's not a material improvement to the entire HVAC system. If we look at all 10 HVAC units, all the ductwork, replacing 1 out of 10 is not material, therefore you can deduct it as a repair. And I think they might have actually used 2 out of 10, but you can deduct it as a repair rather than having to capitalize it. So we're looking for a 30% materiality threshold. It's never actually been stated anywhere that it's 30%, but if you read between the lines, you can kind of see that's what they're getting at.
Okay.
So that's what we're looking for. But from an operator perspective, they don't need to remember all that. All they need to do is just keep really good records. So if I'm buying a 20-unit property, when did I replace various components of various units? I don't want to give to my CPA at the end of the year that I had a $5,000 carpet replacement. What specifically was I replacing? Which units? How many square footage out of the total square footage? Those types of records will help you optimize.
Okay. And then is there benefits to capitalizing versus expensing?
Yeah. I mean, if you capitalize, you definitely make your net operating income look higher, right? So I can push everything off of my profit and loss statement by capitalizing. I think that smart deal sponsors will also look at a statement of cash flows while they're analyzing property to really understand what the true expenditures are on an ongoing basis. But that is something that you could do. So if I have a $10,000 expenditure, I could put that on the balance sheet as a 27.5-year property, and 10,000 divided by 27.5, that's my annual depreciation. Or I can deduct it as a repair today and get the full $10,000 deduction today, which might save me $3,000 in taxes. So it's you kind of have to weigh the pros and cons. Typically, everybody's doing the value add up front. And so we'll take as much as we can in repairs up front because we want to tax optimize. And also when you take a repair, when you deduct something as a repair, there's no depreciation recapture at the end. So you're taking the expense now, you don't ever have to pay it back, unlike capitalizing and depreciating. Okay. We'll typically do that up front, and then years 3, 4, 5, you kind of want to calm down on the repairs a little bit, make the financials look really nice by not engaging in that type of value add.
Okay, no, that's awesome. So you've mentioned you've invested in some syndications. Maybe just walk us through, what types of deals that you look to invest in. What kind of is your box?
Yeah. So we've tried a lot. So we've got C and B class multifamily, and then we also have a stake in a couple mobile home funds.
Okay.
So those have been interesting. The mobile home funds have been cash flowing like crazy. The C and B assets are nice and stable. So I don't really know. I mean, I think I'm at the point of my journey that I'm still exploring different asset classes and trying to figure it out. I mean, the nice thing about being in the position that I'm in is that I get to talk to all of our clients, and they are essentially my petri dish, right?
Sure.
So I get to kind of see what works and what doesn't work, and kind of explore asset classes there, ask people questions, and so it makes it fun. Yeah, multifamily. I'm not really a fan of Class A multifamily for where I'm at personally today, but B and C class multifamily and mobile home parks are really interesting to me.
And is that just due to cash flow, or maybe just elaborate on that? Why you like B and C more than A?
Yeah. Well, I think it's cash flow and stability. I think that it's good to have a little bit of both. You know, in down markets where everybody loses jobs and things, people come out of Class A and go into Class B, and out of Class B and go into Class C. And then in up markets, people leave Class C and go into Class B. So in my opinion, Class B is a pretty good spot to be across the board, regardless of the overall economy.
Awesome. Well, Brandon, this has been super, super helpful, for me personally, as well as, all of our listeners. So really appreciate your being so gracious with your time. How can our listeners get in touch with you?
Yeah. So thanks for having me on. This has been a lot of fun. And your listeners, I almost said my listeners, your listeners.
Well, you do have a great podcast as well. So maybe you can tell people how to find you on that, because that's a wealth of knowledge that you share there.
Yeah, so that's the Real Estate CPA podcast. We interview investors and ask them tax and accounting questions, so it's kind of fun. And if you ever want to get one of your deal sponsors under the gun, go ahead and refer us out, and we'll ask them a bunch of tax and accounting questions for you. But yes, the Real Estate CPA podcast, that's fun. I do that with Tom, my co-host. And if you want to get in touch, you can just go to www.therealestatecpa.com. And you can check us out there. We've got a lot of information, a lot of content, a lot of educational pieces, coming out with some white papers, and it should be good.
That's great. Well, this has been fantastic, Brandon. Thanks again for being so gracious with your time, and really appreciate it.
Thanks, Ryan, for having me on. I appreciate it.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.